Hi, this is Krupakaran Rajendran. Welcome to Trading with Groww channel. This is episode 4 of Masterclass where I'm going to cover about how to create a winning trading strategy.
First, we need to understand the importance of following a trading strategy. See, most traders, when do they make the huge loss is when they panic, when they do not know what needs to be done. When a particular trade is going against them, suddenly their brain freezes, they are not able to make any specific decision. So when a specific trader will get into the situation of a panic mode is when he doesn't have a clear-cut plan. So when a particular trade is taken, he needs to be very clear, like in case if the trade is not going well with him, or if the trade is going completely against with him, what he needs to be done. So when to enter, when to exit, how much quantity that he needs to buy. So when you have these clear-cut rules, he will never get into a panic mode because he clearly knows what he needs to do when a trade is going against him. But when a particular trader doesn't have these kind of trading strategies, then he tends to make many decisions over the long period of time and eventually he burns out. So having a concrete trading decision is the most basic criteria for any trader to be successful in the long run. There are many things that needs to be done. For an example, you can do a trading strategy with respect to stocks, you can do it with index, you can do it with any kind of instruments that you want to trade. But you cannot simply create a particular trading strategy just because you need one particular trading strategy. You need to ask yourself what kind of trading strategy will be suitable for yourself. Say for an example, you are a working professional and you do not have a time to sit from 9 o'clock to 3 o'clock. In this case, what you can do is, if you simply buy some trading strategy from someone, or if you simply Google about trading strategy and start following it, you might not be able to follow it because this specific intraday trading strategy is not in align with your personality, because you are so busy with your day job and you would not be able to follow the intraday trading system with the discipline. So that is why you should ask yourself what kind of trading strategy will be suitable for me. So if you are a working professional, then a swing trading, a positional trading will be much more a better option than an intraday trading, because intraday trading might be looking lucrative for you, but positional trading and swing trading is more suitable for you, where there is a high probability that you might be able to follow that for a longer period of time. So the first foundation when you try creating a trading strategy, you need to align all these things based on your own personality trait and then start working towards that. And the next part is understanding the overall market mechanics. Say for an example, if you wanted to trade with commodities, gold, silver, copper and all these things, then you can completely trade commodities. And if you wanted to trade with stocks, yes, you can do it, but you need to understand the overall mechanics, like what makes these price moves. So if it is a commodity, it is mostly cyclical. There will be a period where gold prices will tend to go up, silver price will tend to go up, crude prices might tend to go down. So these kind of commodity, when you deal with or when you try to trade with these commodities, you need to understand which kind of cycle these particular instruments are currently in, and accordingly you need to create trading strategies. And similarly, when it comes to stocks, so there will always be period of bull run in the markets. So you might assume the overall luck with your skill set. So any stocks, like for an example, during any kind of bull run, any small caps, mid cap stocks tend to go up. So if you buy those stocks, and if you tend to assume that it is mainly because of your skill set, those stocks have been picked up and it is going up, then that is called as beginner's luck. So what happens is, during bull market, many stocks tends to go up, but during bear markets, 90% of the stocks which moved up will crash drastically. So what really matters is, it doesn't matter how much returns you are making during bull run, but all it matters is how much you're losing during the bear market. So that is what the risk management, money management will come into the picture. So what kind of stocks you buy in, or what kind of trading strategy that you follow, all these things can just clearly tell you the entries, exits and all those parts. But the risk management clearly tells you what should be the ideal risk that you need to take with each and every trade. That is what will help you in sustaining these kind of down periods. So when it comes to trading strategies, most of the traders give utmost importance to winning accuracy. They always want 85% winning accuracy, 95% winning accuracy trading system. So if they take 10 trades, they want 9 trades to be right. So what basically traders want is, they always want to make profit, they do not want to make loss. So we are always want to be right most of the time. So that is why most traders give importance to winning accuracy. But in this example, I'm going to explain you why winning accuracy is not very important when it comes to trading strategy. So let's take this example. I have 3 different trading strategy in front of my system. 90% winning accuracy, 10% winning accuracy, and 50% winning accuracy. So this 90% winning accuracy, which means that if you take 10 trades, 9 trades is going to be in profits and 1 trade is going to be in loss. Everybody likes that, right? But what really matters is how much you are making when you are right and how much you are losing when you are wrong. So in this 90% winning accuracy system, on an average, I am making 1000 rupees profit on every trade, on every winning trade. And when I am losing money, I am losing 10,000 rupees. So what happens? 10 trades, we are happy to make 1000 rupees, 1000 rupees, 1000 rupees profit. But in one trade, we are losing money. But in that one trade, we are losing almost 10,000 rupees. So in 9 trades, you make almost 9,000 rupees, but in one trade, you ended up losing 10,000, which wipes out all your profits. So when you have this kind of trading strategy, which can give you 90% winning accuracy, but still on the long run, after 100 trades, if you calculate, overall this is having a negative expectancy. So even though the 90% winning accuracy looks lucrative on the over the long run, but actually this is going to end up in making losses because you are not really making good profits in it. So when you combine how much you are making when you are right and how much you are losing when you are wrong, that gives you the right proportion. So strategy A, which is having 90% winning accuracy, is not feasible enough. Now let's move to strategy B, which is having 10% winning accuracy. So strategy A is like shorting and OTM options, where you end up making profits most of the time, but once in a while when suddenly market moves big time, your OTM options like 5 rupees, 10 rupees can go to 50 rupees or 100 rupees and you lose more money. But here, this 10% winning accuracy is like option buying, where you buy this OTM options like 5 rupees, 10 rupees most of the time. Once in a while that can give you huge profits, but most of the time that is going to end up in going to zero, right? So this 10% winning accuracy is like you take 10 trades, 9 trades going to be end up in loss, but 1 trade is going to end up in profits. But in this one trade, you are making 10,000 rupees profit. In the remaining 9 trades, you are okay to lose 1000 rupees. So what happens? In the long run, this strategy is giving you a positive expectancy. So after 100 trades, this still ends up in a 10,000 rupees of profit. But the other one, which is having 90% accuracy, is not ending up in good profits. But this system, which is having only 10% winning accuracy, might look good in Excel or in the backtest, but psychologically, it is very difficult to follow. Imagine you have put in your capital, taking loss today, and tomorrow coming and trading again, taking loss today. Back to back, you are facing 9 continuous losses. So will you still have the guts to take the 10th trade? No, it is very difficult, right? So psychologically, it is very difficult, even though statistically it is profitable in the long run, it is psychologically very difficult to follow. So coming to the last one, which is the average trading system most of the successful traders follow, which is 50% winning accuracy. If you take any kind of trend following system, it will have only 35% or 45% winning accuracy. So this 50% winning accuracy, if you see, the average profit it makes is 2000 rupees when it is on a winning trade, and average loss is only 1000 rupees on a losing trade. Now after 100 trades, this specific strategy is giving you almost 50,000 rupees of profit. So what now really matters is, if you focus only on winning accuracy, you will lose the actual game. What you need to focus is not only the winning accuracy, along with winning accuracy, check the risk reward ratio. How much you are making on a profitable trade and how much you are losing on a losing trade. That will significantly impact your overall trading system. So when you create a trading system, you need to keep this in mind. Discard the winning accuracy. You don't really need a high winning accuracy. Focus on the risk reward ratio and accordingly create the trading system.
And the most important basic foundation of winning trading or creating a trading system is having a realistic expectation. So people looking into social media tend to think that you can make profits every single day, every single month, every single quarter. Or people who are having just 1 lakh capital can make 10,000 rupees every day. So those things are unrealistic expectations set by social media. So what is the realistic expectation that you need to have? See, before that, you need to understand one important criteria of having a realistic expectation is because everybody knows Warren Buffett and everybody knows Charlie Munger. But there is a third person called Rick Gurry. So this guy was also part of Berkshire Hathaway. But now everybody knows Warren Buffett and Charlie Munger, but nobody knows about Rick. Why? Because during 1970s, even though all these three partners together created Berkshire Hathaway, during 1970s, Rick what he did was he used to pledge his shares and take leveraged bet. He used to take leveraged trades, due to which he started taking huge positions in markets. And when the market tanked, he ended up losing more money. And eventually, Warren Buffett has to buy out his shares and eventually moved out of Berkshire Hathaway. So when a particular person who asked during an interview to Warren Buffett why Rick is not part of Berkshire Hathaway, what happened to him when you three together started? Now only two people are famous. The third guy is not really famous. So what Warren Buffett said was, me and Charlie Munger, we always know that we are going to be rich one day, but we were not in a hurry. But Rick was in a hurry, due to which he took much leveraged positions and ended up losing most of his money. So this is a concrete example of setting the realistic expectation to keep in your mind when you are creating a trading strategy. So when you wanted to make money much quicker, you tend to make all wrong decisions. That will eventually put you out of the market. So having the right expectations, having the right returns expectation is most important when you start creating the trading system. Only then you will get into the actual success journey. So what should be the ideal returns expectation?
So the ideal returns expectation is to keep it realistic. So what happens is, the table that you're seeing right now tells you how much returns that you need to make. And like for an example, if I'm making 10% returns and you divide that 10% from 72, that will tell you 7.2 years. So if you're making 10% returns per year, then it will take 7.2 years to double your capital. So whatever the returns that you're making, 72 divided by that returns will tell you how much number of years it will take to double your capital. So all I'm aiming is to focus on 20 to 30%. So if I'm having a 30% returns expectation from trading, then for every 2.4 years, I can easily double my capital. So now I'm not in a hurry. I know that if I'm starting with 1 lakh now, in the next 2.4 years, I can double my capital from 1 lakh to 2 lakh if I'm just making 30% per year. That's all. So now my returns expectation is set right. Now I will not take huge risk. Accordingly, when I create trading system, then it will suit my personality, it will suit my expectation, and I can easily tend to follow it in the long run. Only when our returns expectation is so huge, we tend to make irrational bets. We tend to make huge risk. That will eventually put us out of the market. So this is also one of the strongest foundation that you need to keep when you start creating any kind of trading strategy. So now let's take an example. Say suppose as a trader, there are two different traders. There is an option buyer and there is an option seller, right? So most people want to get into options buying, mainly because the capital requirement is very minimal and they tend to see there is a huge risk reward ratio that is available in option buying, where they were able to see multiple times some 10 rupees, 5 rupees options premiums going to 50 rupees, 100 rupees, making 10 times, 20 times high returns, right? But you need to understand one thing when it comes to option buying. See, option buying is like, it follows a Pareto principle, which means that 80% of your overall profits as an option buyer will come from 20% of the trades. And those 20% of the trades are the one which is going to give you huge move, like market moving big time on the upside or on the downside. Only when those huge moves happens within short span of time, these option buying tends to make huge returns. Otherwise, option premium will go down because of time decay and you will not able to make any money. So option buying might seem very, very easier, might seem like, okay, this is much good or better option when you wanted to do a futures trading or option selling, because option buying, small capital, huge returns, so most people try to get into it. But when you dig deep, you will see that you might end up making 10 back-to-back losses, 12 back-to-back losses in order to capture that one big trend. So you need to ask yourself, are you ready to handle back-to-back multiple streaks of losses? And if you are completely okay with that, then go with option buying. So if you are having 1 lakh of capital, a successful option buyer will not put all his 1 lakh capital in that one trade. What he'll tend to do is, okay, I have 1 lakh capital and I can take 5% risk, which is 5,000 rupees. So now what he'll do is, he'll still do option buying, but the number of quantity, the number of lots that he wants to buy will be totally depend upon this 5,000 rupees. Say suppose if he is buying any specific option, and if the overall option premium risk is, say suppose 1,000 rupees. So he bought an OTM option 1000 rupees is the risk per lot, like he bought it. So now he'll tend to think, okay, for one lot, 1000 rupees is my risk. Now I have 1 lakh of capital, and in this 1 lakh, I wanted to risk only 5%, which is 5000 rupees. So how many number of lots I can buy? Now he'll say I can buy only 5 lots, because if I buy 5 lots, my maximum risk is only 5000 rupees. So even if it goes to zero, I'm not worried, because out of this 1 lakh, I still have 95,000 rupees left. So now what happens is, he is also an option buyer, but the number of lots that he is taking is totally dependent upon his risk management, the risk appetite that he is able to take. Now he will tend to take the trade. If that trade is lost, he is not at all bothered, and he still have 95,000 left. Again, he'll repeat the same thing. But once in a while, after 3 or 4 trades, if the 5th trade is giving him 10 times returns, 20 times returns, now he can make huge returns. So he's risking less, and he is calculating how many number of lots he can buy based on his overall risk capital, and accordingly he does this option buying. So this is how we need to do an option buying when you wanted to deal with a lower capital or higher capital, whatever it is. Do not put all your capital in just one trade and expect it to make 10 times, 20 times returns. Try to risk this X percentage of your capital in each and every trade. That is going to help you in the long run. Now let's take an example for option selling with an example of backtesting also. See, not only the idea is important, you also need to validate your idea. And in order to validate your idea, there are multiple third-party platforms available which helps you to backtest it. For an example, in this video, I'm going to explain a simple backtestable trading strategy for option selling, based on which you can take a trading decision whether to follow that specific trading system or not. So this is a platform called algotest.in, where I've selected Bank Nifty index. Now I wanted to create an option selling system. Okay, so I've selected options, I've selected sell, I've selected call, and I've selected put option. So what we are basically doing is, we are shorting at the money call option and at the money put option, an intraday trading strategy we are trying to create here. So we shorted at the money call option and at the money put option, and we wanted to keep a stop loss of percentage. Select the percentage here. I'm selecting 30%. I'm selecting 30%. So what this specific strategy says is, you short both at the money and now at the money call option and at the money put option at 9:30, and keep an individual stop loss on those legs, 30% stop loss and 30% stop loss. That's all. And we have not selected anything else, and we are entering at 9:30 and closing the trade at 3:15 in the evening. And we are selecting the date, like from 1/1/2017 to 2024. We are going to backtest this trading strategy, which will automatically calculate what would be the overall returns that you can make, what would be the overall drawdown, etc. So let's run this, and once it gives you the result, then we will dissect what are the things that you need to focus on when you are creating a trading strategy. How do you finalize it? How do you do a complete detailed analysis, and then start going and doing a live trading? All those things we'll see it once it gives you the backtest results, because this backtest is really important. That is going to tell you whether a strategy is working or not, whether it is profitable or not, based on the historical data sets. So now we got the result. The strategy is really profitable, where it has given almost 3.5 lakhs of overall profits, and this is the overall drawdown, and this is the overall month-wise profits and overall year-wise drawdown for one lot. So for one lot, probably you might need 1.5 lakhs of overall capital. So this is how the overall returns looks like. So except 2023, rest all the years ended up in profits. And this was the 3,000, 6,000, those things are the maximum drawdown, how much you could lose over the long, like over a period of time. So this clearly states that, first thing, strategy is profitable, and second thing, it has risk, and that risk is also not much. The maximum risk that you are seeing is 30,000 rupees, right? So now as a trader, what you can see is, okay, if I trade with one lot, 30,000 is the maximum downside I'm going to see, and overall positive side 3.5 lakhs is on the upside I'm going to make, right? And these are the overall returns. Like it tells you, like now almost 200 rupees is the average profit I'm making in this particular trading strategy. 63% is the winning accuracy, and overall drawdown, and overall back-to-back losses, 7 losing streaks, and back-to-back 19 winning streaks. So you have all the metrics now. So now you can decide, okay, this is the overall result if I trade Monday to Friday. Now, if I wanted to trade any specific days, like say suppose I wanted to trade only on Wednesdays, then how the overall results will looks like. So now I've excluded all and I've selected only Wednesday. Now it will tell you the same parameter. So almost I'm making 72,000 rupees as a profit. Winning accuracy is same, average profit is same, and the maximum drawdown is reduced to 16,000 rupees. And rest all the parameters you can see. So this is how you can check, like, okay, if I'm trading Wednesdays and Thursdays or Monday to Friday, so how the overall drawdown changes if I'm trading on all these days. So you can easily check. If I wanted to trade only on Fridays and Mondays, you can specify that and see how the drawdown looks like. So Mondays and Fridays, overall drawdown is 25,000. And if I trade only on Thursdays, the drawdown is like almost 18,000. So you keep changing all these parameters and overall returns also varies. So now you can decide, okay, overall, instead of selecting day wise, it's better to trade Monday to Friday all days because that is giving the highest profit with minimal drawdown. Now you can go ahead and start trading it. So this is how you now test your ideas, validate it, and if it's working fine, giving you positive results, and start trading in the live markets. So these are the important parameters that you need to consider when you start creating a trading strategy. So this is what I want to convey in this masterclass video. So I hope you found this video really helpful. In case if you guys have any questions with whatever the explanations that I have done, please post it in the comment section. I'll address it. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.